Welcome to the Deep Dive. Today we're taking a complex stack of financial reports, analyst notes, and management commentary,
And we're really focusing on the latest data here, Q1 and Q2 for FY26.
and turning it all into a clear, structured, fundamental analysis for Aarti Pharmalabs Limited, or APL. We're not just, listing numbers today. Our mission is to understand the core narrative that's shaping APL right now.
Which is really this painful pivot, isn't it?
Exactly, a pivot from a solid legacy business to a high-margin, growth-focused future. And this story, it involves some serious short-term sacrifices for what could be massive long-term potential.
That's absolutely right. And for you, our listener, we're doing a 5-part dissection. First, we'll establish APL's competitive foundation, its moat.
Okay.
Then we'll tear into the P&L to understand why profitability is, contracting. Next, we check the financial health of the balance sheet and cash flow.
Right.
Assess efficiency ratios like ROE, and finally, weigh that ambitious growth strategy against the immediate risks.
Okay, let's unpack this. APL spun out from Aarti Industries back in 2022. But what is APL's engine? What 3 core things keep the lights on and generate revenue?
So APL operates deeply within specialized chemistry for the pharma and nutraceutical space. They have 3 crucial verticals.
Okay.
First, you have the foundational business, generic active pharmaceutical ingredients. That's API and their intermediates.
The basics.
Right. Second, they have this unique specialized niche in xanthine derivatives, which includes compounds like caffeine.
And the third.
And third, the one everyone's talking about, the high margin future, contract development and manufacturing, or CDMO services.
So what's the segment breakdown today? Are they still relying heavily on that old guard?
In Q2 FY26, yes, absolutely. Xanthine is still the largest segment at 51% of turnover, and that provides tremendous stability.
Okay, over half the business.
Exactly. API and intermediates are at 39%, which means that high-growth CDMO segment, it's currently only 10% of total revenue.
Wow, just 10%.
And that disparity, that's really the key to the entire investment thesis here.
When we invest, we're always looking for a moat, a sustainable, defensible competitive advantage. In pharma, that's usually regulatory approval and specialized tech. What makes APL so tough to copy?
Well, the moat is substantial, and it's been built over a quarter of a century. APL has 6 plants, 3 R&D centers, and crucially, they hold major international regulatory approvals.
The big ones, I assume.
The biggest. US FDA, UGMP, EDQM. For a sophisticated investor, this means their products can be sold directly into the most tightly regulated, highest value markets in the world.
So new entrants have a massive time barrier just to get that basic trust.
A huge barrier.
That's the quality assurance mode.
Yeah.
But what about the technical edge? We heard they have cryogenic reactors and specialized HPAPI facilities. I mean, what does running a reactor at minus 100 degrees Celsius actually let them do that competitors can't?
It's the difference between, say, basic cooking and gourmet molecular gastronomy. These extreme conditions, like ultra-low temperatures and high-pressure hydrogenation, they allow for highly precise, specialized chemical synthesis.
Which you need for cutting-edge drugs.
Exactly. Particularly in complex oncology or cytotoxic products, the HPAPIs. This is why their CDMO margins are so high. They're performing chemistry others simply cannot touch, and you can't forget xanthine, their largest segment. They secure that 51% revenue chunk by being the only backward integrated source from India that's independent of Chinese competitors.
That's a huge supply chain advantage.
It is. It guarantees supply security, which is paramount for their biggest customers, the beverage industry, who bought 71% of their xanthine volume in Q2. That kind of client dependence gives you reliable revenue visibility that generic API sales just don't have.
That strong foundation is fueling their pivot. But if the strategic investment is so massive, how is it impacting the income statement right now? Let's dive into the P&L.
The P&L, it definitely tells a story of current stress. Operational revenue grew sharply into FY24, but then saw a minor dip in FY25, shrinking slightly from around 5,600 million rupees to 5,500 million rupees.
A slight jump.
But here's some vital context. You cannot compare H1 FY26 directly to the past. The consolidated revenue looks optically lower.
Why is that?
It's because Ganesh Polychem GPL is now only consolidated as a joint venture. So we only see its profit share, not its full top-line revenue.
So that makes a direct comparison tricky, right, when they're making this big strategic shift.
Exactly.
Okay, let's talk operational profit. EBITDA, or earnings before interest, tax, depreciation, and amortization. It's really the true operational profit. The trend here seems, alarming. It's signaling margin contraction.
It's a definite headwind. The EBITDA margin peaked beautifully in FY24 at almost 26%,
Right.
but it contracted severely, dropping all the way down to 17.37% in FY25. The Q2 FY26 consolidated margin was only marginally better at 17.76%.
That is a substantial drop. We're talking 78 percentage points
A
loss.
huge drop.
So why such a severe contraction? Management cited competition in the generic API segment, which, is expected. But they also mentioned a strategic decision to prioritize capacity for lower margin intermediate production.
Isn't that just a convenient way to explain away competitive pressure? I mean, how much of that 7-8% margin contraction is truly strategic versus just market-driven?
That's the critical question you have to ask. The sources suggest it's a mix, but the strategic decision is very real. They are essentially using their lower margin legacy API business as a cash engine.
To feed the high-growth CDMO monster.
Exactly. They are deliberately dedicating capacity to manufacture complex, multi-stage intermediates now to prepare for large, high-margin CDMO contracts that will execute later on.
So they're sacrificing near-term margins for guaranteed high-margin CDMO revenue down the line.
That's the bet they're making.
Okay, so near-term pain for long-term capacity utilization. How did that translate to PAT? Profit after tax, the ultimate bottom line. PAT followed the EBITDA trend right down. They hit a peak net income in FY24 at 883 millimeter rupees, and then the bottom just dropped out to 555 millimeter in FY25.
And the margin?
The PAT margin dropped from over 15.6% to below 10% in FY25. And Q2 FY26 was even tougher with a PAT margin of only 6.67%. We also have to note a non-operational surprise in Q2 FY26. A significant non-EBITDA foreign exchange loss.
Where'd that come from?
This happened because APL had long-term foreign currency loans that were unhedged. So when the rupee depreciated sharply, the liability suddenly cost them much more to service and repay.
Ouch. A nasty surprise that hits net income but isn't reflective of their core operations.
Precisely.
That operational stress from the pivot needs context. If they're investing heavily and deliberately squeezing margins, the balance sheet has to bear that weight. Here's where it gets really interesting. How healthy is their financial structure?
From a structural perspective, the balance sheet looks robust. Total equity has grown consistently, reaching over 18,000 million rupees in FY25.
And what about debt?
Their debt profile is very manageable. The net debt-to-equity ratio remains low, moving from 0.13 up to just 0.19 across the last 3 years. They have leverage capacity.
And that leverage capacity is being used, right? The massive capex required for this shift must show up somewhere obvious.
It shows up very clearly in one place. Capital Work in Progress, or CWIP. This is money being spent on physical assets that are not yet operational.
And what's the number?
The CWIP jumped hugely from about 785 millimeter rupees in FY24 to over 3,000 millimeters in FY25.
Wow.
That's the physical manifestation of the strategic pivot. It's the cash funding the new Atali Greenfield site, which is their primary bet on the CDMO future. Now, let's look at the quality of earnings through the cash flow statement. Cash flow from operations, or CFO, was stable, reaching 332 crores in FY25, but the real challenge, the operational stress point, is the working capital cycle.
That's the big operational risk, isn't it? The cash conversion cycle stands stubbornly long at around 200 days.
It is substantial.
200 days. That means APL is tying up cash for over 6 months. That is a massive operational risk in a capex-intensive phase. What's driving that time lag?
Well, it's elongated by high debtor days, sitting around 102, and extremely high inventory days, which can reach up to 230 days.
And what's management's explanation for that?
For H1 FY26, they acknowledged it. They argued the inventory buildup is intentional. It's the raw materials and multi-stage intermediates being manufactured now for those large CDMO contracts.
So they're burning cash to build inventory today,
Yeah.
so they can execute massive profitable sales in the second half of the year.
That's the plan. But this is critical. You have to monitor this stream carefully if the execution of those CDMO contracts gets delayed or if the market for generics softens even more.
Then that 200-day cash conversion cycle, coupled with rising debt for the Atali plant, could create genuine liquidity pressure.
It's a calculated high-stakes risk.
Let's look at how efficiently they are deploying all that capital. We need to know if the underlying business model, despite the short-term pain, is efficient. Let's focus on ROCE and ROE.
Okay, so ROCE, or return on capital employed, shows how effectively they are using all their capital, so that's owner's equity plus borrowed funds, to generate profit.
And how does that look for APL?
APL's ROCE has been consistent and decent. It's ranged from 16% to 19% historically, and it's sitting at 16.2% in FY25. This shows the core operations are fundamentally healthy and profitable once that capital is deployed.
But the shareholder ultimately cares about ROE, return on equity, the profit generated specifically for every rupee the shareholder invests.
And this is where that short-term pain is most evident for the shareholder. APL's average ROE over the last 3 years has been noted as low, at 13.6%, slightly improving to 13.7% in FY25.
So why is the ROCE consistent but the ROE is low?
Well, if we connect the dots back to the balance sheet, the explanation becomes clear. That massive CWIP spike is the culprit.
The idle capital.
Exactly. The capital is currently deployed in fixed assets, the physical
Yeah.
Atali plant, but it's not yet operational, and so it's not generating incremental revenue or profit.
So the ROC is consistent because the operational capital is working, but the ROE is low because all that new equity invested in future capacity is just sitting there waiting.
Precisely. For APL to justify that multi-billion rupee capex, both ROCE and ROE have to surge once Atali is fully commissioned and starts ramping up revenue.
So what does this all mean for the next few years? Let's connect the strategy to the future potential. What are management's big growth drivers and targets?
Management has set an aggressive, company-defining long-term target. They want all three segments, API, xanthine, and CDMO, to each achieve USD 100 million.
Which is approximately 1,000 crore rupees.
Right, 1,000 crores in revenue within the next 3 to 4 years.
That's an ambitious leap, particularly for the CDMO segment, which is currently only 10% of revenue.
Exactly. But that's the focus. The guidance for CDMO growth in FY26 is 30% to 40%, and they expect to exceed that.
And that's driven by a deep project pipeline.
It is. 33 commercial projects and 59 active projects, mostly in late-stage phase 2 or 3 clinical trials, so they're ready to scale up. And they're expanding capabilities into emerging, highly complex areas like liquid peptides to secure that future.
And this growth relies heavily on bringing that new capacity online. Tell us about the Atali ramp-up timeline.
The scale is massive. The Atali Greenfield site has 450 plus KL of initial capacity, but it's scalable up to 8 to 10 times that.
Wow.
Phase 1 commissioning is expected in Q4 FY26. This will boost total company capacity to over 1,500 KL. And crucially, they are simultaneously expanding their most stable segment, xanthine, from 5,000 to 9,000 MTPA by year-end.
Before we discuss the major risks, let's quickly touch on the cost story.
Yes, strategic cost optimization is underway. The 21 MW solar power project they started in FY24 is expected to generate massive annual savings of 25 to 30 crore rupees.
Covering about half their power needs.
Exactly. It's a crucial internal lever to protect margins going forward.
Now for the flags. We've established the operational pressure. But what are the immediate red flags or near-term headwinds investors need to monitor?
The biggest near-term headwind is earnings volatility from the new capacity hitting the books. The Greenfield Atali project will incur upfront operational expenditure OPEX costs.
How much are we talking?
An estimated 4 to 5 crore rupees per quarter, plus depreciation, starting around Q4 FY26.
That situation is like buying the most advanced Formula One car, but having to pay the full operational cost for 3 months before the first race actually starts and generates revenue.
Precisely. That cost hits the P&L immediately, but the substantial incremental revenue for that new capacity won't ramp up for another 2 to 3 quarters after commissioning.
So H2, FY26, and early FY27 will see an earnings drag.
A definite drag.
Another flag that caught our eye was the promoter shareholding. We're seeing a 4% drop in promoter stake in 18 months, falling from over 46% down to under 43%. Given this massive capex push, is that a signal of divestment confidence, or are they just raising funds?
Well, the sources just report a continuous decrease, and management hasn't provided a very aggressive public defense. It's a factor you have to monitor.
It doesn't exactly project overwhelming confidence.
It certainly doesn't. A continuous drop during a critical expansion phase warrants scrutiny. And finally, we have to mention geopolitical risk. Their U.S. sales exposure is low at 8–10%, and current products are exempt from tariffs.
Boy.
But management acknowledged that extreme tariff changes, say a 50% tariff, would force a contract renegotiation, since their contracts are largely FOB-free on board. The cost would fall on the buyer initially, but it would disrupt the business model.
This has been a deep dive into a company making some very tough choices. APL is undergoing a painful operational transformation, really, sacrificing short-term metrics to build future dominance. Let's distill the most critical points.
We can start with the 3 biggest structural positives. First, the high-growth engine. The CDMO segment is clearly the priority, aiming for significant growth, leveraging that high-margin complex chemistry like HPAPI and cryogenic synthesis.
That's a strong long-term margin profile.
Exactly. Second, strategic capacity. The massive Itali greenfield site and the xanthine expansion position APL for significant volume growth that will materialize once commissioning is complete.
So they're building for the future.
They are. And third, the cost and quality moat. They've secured a cost advantage with that 21 milliW solar project, and that's combined with a strong, globally recognized regulatory track record, which secures their access to the highest value markets.
Okay. Now, for the three most significant negatives, which are largely execution and financial risks that need to be resolved in the next 18 months.
First, margin compression. The severe and recent drop in profitability, with the EBITDA margin falling from nearly 26% down to 17–18%, that must reverse immediately upon the CDMO ramp-up.
It's a show-me story now.
Absolutely.
Yeah.
Second, ramp-up costs and time lag. The Itali plant introduces immediate OPEX and depreciation costs starting in H2 FY26. That will be an immediate drag on profitability before the substantial revenue stream fully materializes. This demands patience from investors.
And the
Third, working capital strain. The critical combination of increasing debt, that stubbornly lengthy 200-day cash conversion cycle, and high inventory levels requires very careful management to ensure the cash burn for this pivot doesn't strain liquidity.
That balanced near-term pain for long-term capacity is the core story here. Thank you for synthesizing this complex set of data, and for you, the listener, something to mull over. Given that both the CDMO and the xanthine businesses are targeting that 1,000 crore revenue mark in the next few years, and CDMO is the highest margin segment, what inflection point does APL reach when the CDMO segment, currently just 10% of revenue, begins to contribute 25% to 33% of the company's total revenue? Will the sheer volume from the xanthine expansion provide stability during the inevitable volatility of the Itali CDMO ramp-up, or will the high-margin CDMO work immediately overwhelm the existing legacy segments to become the true game changer? We'll keep watching the data.